Good afternoon, everyone joining. We'll be kicking things off in about 3 minutes time. So I can see the room filling up. So I will just waiting on my fellow panelists, and we'll kick things off at midday. But look forward to getting started shortly. Hey, Sam.
Hey, Kieran, how are you?
Yeah, very good.
Good. We've got 25 participants on already. Look at that.
Yeah, indeed, indeed. Um, I think I was just saying to the people there, because when I clicked the start the webinar, I think everyone's kind of coming in. So I just said we'll kick off on the hour, just give a few more people a chance to
Yeah, perfect.
sign up. Hey, Johnny.
It'd be great to know where everybody is in the country whilst we've got 2 minutes to chitter chatter. Where are you, Kieran? I'm not actually sure.
I'm in London, so our office is in Regent Street. How about yourself?
I'm in sunny Newbury in Berkshire.
Very good. Nice.
Well, I'd love to say it's sunny, but it's not really. Yeah, it'd be good to know where everybody else is. If you put put any details in the chat of whereabouts you are, that'd be lovely to hear. Is there general chat switched on? I think I may have asked people.
So the Q&A box is on, and we'll be able to ask anyone in. So I see we've one attendee who's popped up their hand. So Maxine, did you have a particular question before kicking off?
Chat is disabled.
Yeah, it's just chat's disabled, guys, so we couldn't reply.
Okay, perfect. Q&A. Oh, so they are coming through. So we've got people from Middlesbrough, Birmingham, general chat as well. I'm from Theo.
I'm in Theo. Hey, Tim. Yeah, just down the road from you.
Okay.
Wolverhampton, Warrington. We've got a really good spread, actually, haven't we?
Some good Midlands representation. Okay, someone from the sunny southwest. Love it. Okay. Awesome. Okay. Well, we've now got over 50 people already joined, and hopefully we'll have a few more trickle through as we kick things off. But great to see such strong representation of I'm assuming business owners, founders, startup scale-ups from all around the country. We're delighted to have you guys here to join us today. Just to kind of give you a quick overview and housekeeping, my name is Kieran Burke. I'm co-founder of Swoop, and my co-host Sam, who will introduce himself in a second. We'll be running you through all different forms of sources of funding, from lending, equity, grants, R&D. Sam's going to be unpicking some great practical tips, not just in terms of equity fundraising, but also all the practicalities that come with it. We definitely want this to be as interactive. We'll absolutely leave time at the end to do Q&A, but please feel free to use the Q&A box. I say, so I can see Dan says, nice to see us both and looking forward to today. We're both looking forward to chatting to you guys as well. And nice to meet you, Rosman, Kareem from the UK as well. So keep those questions coming in the Q&A box, and we'll answer as we go, but also we'll leave time at the end to to take any questions. I'll just quickly share the slides, and then I'll pass over to Sam as well to introduce himself.
Great stuff. Lovely to be here. Our first webinar, Kieran, with Swoop and FounderCatalyst. So this is awesome. So lovely to see everybody. I guess by way of intro, I'm Sam Simpson. I'm one of the co-founders at FounderCatalyst. I became an accidental entrepreneur in 2013. So I'd spent 18 odd years of my life working in corporate world, doing corporate stuff. And and then in 2013, the business I'd worked for 15 years disappeared overnight. So I started my own tech company, and we grew pretty well. We went from 0 to 30 million revenue in 4 years, and then exited to private equity. So I've been the founder side of the table probably 5 times now. And I started angel investing pretty much the minute I exited my business. I started angel investing. I've got about 35 investments over the last 8 years, about £1 million deployed. And my reason for starting FounderCatalyst, I kept bumping into founders who had amazing ideas. They knew they needed funding to achieve their dreams, but they just didn't know how to do it. They didn't understand, SEIS, EIS, which is your superpower in the UK. They didn't understand, how equity funding works and what a term sheet was and where to meet investors. So I thought I would scratch an itch. And here we are 4 years later. Very briefly, in terms of what FounderCatalyst does, we are by far the most cost-effective way of closing a funding round in the UK. I guess to demonstrate that, one of our customers raised £2.8 million a couple of months ago, and our fee was just £1,500 plus that. So in terms of equity fundraising, we are unmatched. And that's unmatched not only in terms of price, but also in terms of Trustpilot rating, in terms of SEIS, EIS approvals, percentage, and things like that. So yeah, really delighted to be here. And Kieran, I'm delighted. Debt is something I know about, but I don't deep dive into. So I'm looking forward to learning lots from you as well.
Yeah, equally, Sam, amazing to get your level of experience, both going through it as a business owner and also an investor. So again, very curious to kind of unpick, and I'll probably ask you some questions along the way, similar to the audience. And then just for a little bit on background on myself. So our platform is designed for business owners, trading businesses to be able to access a broad range of capital solutions. And so we really want to bring everything that's available to you kind of based on your data set. So come into Swoop, you can connect in with your banking, your accounting information, and we should be able to distill what's available to you. And to date, we've had over 300,000 businesses sign up to and create accounts in Swoop, and help distribute over 2.5 billion in funding. And personally, through building Swoop out myself and raise funding, I'm a bit of a walking case study. So today, hopefully, can kind of give you a bit of reflection. We've used everything from grants, debt, and equity. Equity, we've probably done about 13 million. Debt, we've done 3 million, and in grants, we've done 8 million. So again, I can talk you through any of those journeys, or answer any questions on that. Some of it was easy, some of it was absolutely torturous, particularly the equity side of it. So again, can reflect on them and hopefully answer any questions on that side. So yeah, as I said, what we'll do is we'll go through hopefully as many different products as we can, but please do kind of throw questions in along the way. We want this to be as interactive as possible and hopefully add value back to yourselves where you might have pertinent questions, whether you're going through funding at the moment or you're considering it, or thinking about it in the future. So yeah, reiterate again, we're going to start with a bit around the debt side of things with myself, go over to Sam to chat through everything on the equity side, flick back to myself to finish off with some grants and R&D, and then open it up as well for any last remaining questions from the audience. So what is debt financing? I suppose a lot of the time when we do these webinars or we have businesses coming to Swoop, people will get very, very attracted by Sam's talk track today, equity, because it can be quite sexy, there's large numbers, and ultimately you're not having to repay the money out in a standard loan. But there are some considerations on the other side of the house when it comes to the lending side of things. Naturally, the money that you do take on from a lending perspective, does need to be repaid, not just the amount that you've taken on, but any additional interest that is occurring. But the key, I suppose, thought back when talking about debt and equity is with the debt position, it does give you control and full ownership of your business, in that you're not giving away a percentage of your business. That being said, like equity investors, debt investors that are coming in and giving you loan, it's not that they're not wanting to know about the business and be connected into the business. So that's also important when considering lending, because similar to when you might get a term sheet, you will get a loan document which will have covenants in it that are really, really important to be aware of, because they'll flag any red flags that bank or lender is looking at should you fall foul of those covenants. But ultimately, what a loan should give you is predictability as well. And so when you are considering loans, you should obviously look at what your day-to-day situation is in terms of the cash in, cash out coming in the business, both here and now and from a forecast perspective, because that allows you to look at it against any particular lend that you might take on, so that you can see what those predictable repayments are going to look like, and whether you have the cash flow or the serviceability in your accounts to be able to do it. And similarly, like the equity side of things, we see many businesses turning to lending when it comes to growth orientation, whether that's acquiring assets such as vans, vehicles, machinery, or expanding their workforce, or looking to get stock finance ahead of a particular busy period like Christmas or Thanksgiving. But equally, when things aren't going as well as possible, or there's seasonality in the business. So again, giving that example of I might have a particularly busy Christmas period right now, so I've taken some lending out to avail of all the stock that I can purchase ahead of my Christmas sales to make as much revenue as possible. But knowing that, say, in January, times aren't as good as the previous quarter, and maybe I have some liabilities like VAT payments that are larger than expected after the increased sales. So again, using lending facilities to maybe spread upcoming costs so it doesn't hit you from a cash flow perspective. So we definitely see both from the growth orientation, but just from cash management, how lending can be utilized. And then I suppose one thing to talk into when we talk about lending is the rise of alternative lenders vis-a-vis banks, and what's available to businesses out there. Because when we think of lending, a lot of the time business owners will naturally gravitate towards the bank, and the banking landscape for businesses, particularly businesses that are in a startup or in a scale up or a trading position from say 100,000 to 20 million, is very, very different today than it was 5 years ago, than it was 10 years prior to that, than it was 15 years prior to that. A lot of the tier one banks that we know are very familiar today are HSBC, Barclays, Lloyds, Santander, NatWest, have very different models when it comes to business banking than what did before. And that kind of relationship, one-to-one banking, branch network approach really isn't there unless you're in a size of considerable finances, say 20 million or above. So what that means a lot of the time for business owners that go down that traditional route of potentially going to the bank and asking them for a lending facility, naturally, because those banks aren't always looking or are able to credit assess those businesses at that size, they're not always able to provide credit facilities. And what we see in the data, that 50% of businesses that are going to banks and get rejected, they will stop their search there and then, and that will be it in terms of their funding journey and whether they will look to other options. And so one thing that I definitely want to get across today is just the plethora of options that are available to business owners, particularly in the UK, where we have such a large alternative finance ecosystem, that where the banks traditionally were serving that market share has been completely taken by a lot of these alternative finance products. And in some cases, a lot of these non-bank lenders are able to compete with price, where they will offer a lot better or score higher to the banks is usually around speed. What they've built is infrastructure systems to be able to read and analyze your information in real time, so that decision making can be reduced to 24, 48-hour type periods. So the application period for facilities can be reduced to other days or weeks. Typically, we see different kind of credit decisions occurring at 50,000 and below, 100,000 below, 250,000 below, and 1 million and below. Ultimately, the larger you get, the greater the length of time and the decision around it. What I also want to highlight is I'm not saying that banks aren't a viable option. They still are absolutely a viable option, but the key considerations for businesses that are going through banking side of things is the time and the opportunity cost it may take. What we've seen as an organization in Swoop over the last, I would say, 9 to 12 months is a real increase in the tier one bank activity, in the volume of loans and interest that they're willing to do at a kind of 20 million and below level, which is really, really great to see. And we're seeing some really competitive rates in the mid to high single digits. And we're also seeing them avail of some of the government-backed schemes like the Growth Guarantee Scheme, which allows them to go a little bit further in their risk appetites. And that is fantastic and really encouraging if businesses are available to get that. But what we're equally seeing is the application times across all of the banks here. We're talking kind of 12 to 16 week periods. Whereas when we look at the alternative finance bucket, which will have a much larger range in terms of interest rates. Again, some will get near to competing with those banks, but again, some will be a lot higher. They're able to compete on speed, whereby they're able to distribute cash and funds once the data is in there from a days to weeks type perspective. So there is a real difference between the two. So what I wanted to do was just kind of give a little bit of a flavor. And again, we can kind of unpick this if there's kind of specific questions around different products. But when we think about alternative finance or even banking finance, one thing that we want to help kind of educate a lot of business owners that are considering lending is it's not just one product or one product fits all. I think most people are familiar with term lending in that I take a sum of money, I pay a sum of interest on top of that over a fixed period of time, which very much still exists today. But what we have seen is a proliferation of different alternative finance or different products to help businesses in certain sectors or scenarios. And they might be super relevant to you and your business and where you're at today. So what I'm going to do is briefly go through some of these different products that exist out there. And again, please feel free to kind of drop in any questions around these products or if you think they might be relevant. So one lending product that becomes very available to new businesses or early stage businesses when they're looking for those first bit of growth capital is a thing called selective invoice finance. And we have providers that will go as low as £1,000 in this particular category. And what this is where a business has an outstanding invoice that they're due to be paid from, say a supplier, and they want to unlock the cash from that invoice. So we typically see this in industries like recruitment, whereby there's long periods between when the client pays you that money that's outstanding, or you might see that in agencies as well, or in marketing or professional services. And what selective invoice finance allows you to do is for you to pick those invoices that you're waiting for outstanding payment for and get that cash funded up front, minus a percentage that the lender will take. Normally, you're able to fund between 80 to 90% of the full invoice value, which you could get immediately, and then forego maybe 5% for getting that cash up front. And that's something that kind of trading businesses can get pretty much straight away as soon as they start to get their first customers. So where some barriers around age exist, particularly where banks, whereby you might need to have at least 2 filed accounts before being able to access bank funding, selective invoices in early stage things. Apologies, guys. I've just seen there's like 4 questions in here, so I did say we will answer on the fly. So I'll quickly jump in and answer these. So we've a question on, what if you're a sole trader with a unique product service that once you start marketing and selling it, well-funded businesses could copy the concept and push you out of the market? In other words, getting proof of concept for investors without the risk of being outspent by a copycat before you get the investment needed to scale. Now, I'll probably pass over to Sam on the equity side of this as well. But my 2 pence on this is, this isn't, I would say, relevant, not that it's relevant, I would say this is relevant for both sole traders and any business. Once you're producing a product and putting it out there, absolutely, it's a competitive ecosystem, and that is one of the kind of things that you would always need to be worried about. Now, depending on the uniqueness or element of it, and if it hasn't got into a commercial state, that's when you can look at things like getting your technology or system patent, which could potentially give you some level of protection. But if it's already commercialized and in a market, then you're not going to be able to get a patent because it's already out there and live. So it's something that you might consider. But I don't know, Sam, if there's anything that you would want to add on that particular question.
Yeah, I think you've given a great answer already, Kieran. I think lots of investors quite often chuckle when founders raise similar questions, because actually there's virtually nothing new in the market. I think every idea is kind of, if you're lucky, an extension of something else. And, if you look at Google, when they launched on the market, there were already 10 different search engines. It was about their execution, and their go-to-market rather than the product itself. I think there are exceptions to that, and as you said, there are, you can use copyright, you can use patents and trademarks and lots of other things to try and protect your IP. The other thing you need to bear in mind is, if you're launching something in 6 months' time when you've got funding, or you're launching something now and you haven't, if you've got a very well-funded competitor, they're going to blow you out there. They're going to outcompete you anyway. That 6 months won't buy you much at all. So, you see this with people putting stealth founder or whatever all over their LinkedIn. It's, the idea is virtually nothing. It's the execution which is key. So I wouldn't be too paranoid. Hopefully that's not too glib an answer, but
no, I think it's good to give the realities of it, and I definitely would concur with you, Sam. I'll just quickly answer 2 more of these deck questions, and I'll go back to it, but we'll keep answering them as they come in. Great to see so many questions coming through. So Susan had a question saying she's getting a flurry of finance emails every day, especially about the government growth scheme. Is this because lending is down and they're desperate, or are they generally trying to help? So I think, this is a really positive thing, Susan, I would say, is what we're seeing both banks and alternative lenders being able to get funding through the scheme. So essentially how the scheme works is the government will have a kind of a pot which they'll take some of the losses if the business wasn't to be successful on the loan. What that means is the credit policies of the bank or the alternative lender can probably go a little bit outside their normal risk appetite to get these deals done. What it also means at a security level is the PG, or the personal guarantee exposure, can be reduced down. So in some cases, it will be only 20%, whatever the capital allowance is left, or whatever the capital is left to be repaid on that loan, versus like a standard loan where there might be 100% personal guarantee on it. So I would see it as a positive thing that we're getting good volume of cash going through the government guarantee scheme, both at a bank and alternative finance level, because what it does give is businesses that weren't originally in a bank or alternative finance original risk profile the opportunity to receive funding, and not only do that, receive funding at a potentially reduced security level as well. So it's a positive thing, and that's probably why you're seeing it from a marketing perspective, because as banks and alternative finance lenders have increased capital to be able to distribute it against it, and they're getting good traction, and we're seeing performance against it, because while the growth guarantee scheme is the new name of the scheme, that scheme has been around for years and years. It was the RLS, the recovery loan scheme before that, the CBIL scheme before that. So because we're seeing various iterations in it, the reason is it's being successful, capital's getting out there, it's getting repaid, and it's getting businesses to grow. So I think from our side of things, we definitely see it as a positive signal. And again, particularly at a bank level, we're seeing some really good pricing on a GGS side of things. So we just did an acquisition deal there last week in Northern Ireland with a 6.75% pricing on the GGS to do the acquisition. Timeline painful, but some really good low pricing, which is great, which kind of leads me to my next question from Paul Cook, who says, aren't the interest rates charged by alternative lenders often excessive? I've seen 2 or 3% per month with the likes of Iwaka. Very, very valid point, Paul. What I would say is it will be impossible to kind of go through it on a lender by lender play today, because we're talking maybe 300-400 lenders in this space. And undoubtedly, lenders like Iwaka will have higher priced products. But what I would say on the Iwaka side of things, if we specifically talk into them, they equally have term lending products that can go up to $1 million, that can be priced. I've seen them come in at maybe 1.2% per month. So they do have the capability to go on one end of the scheme. Now, absolutely, I've seen Iwaka come in at 4 or 5% per month above the thing you're saying. But what they're willing to do is go at a business that's brand new start. So they're willing to make that higher risk appetite. For that, they're offering a much higher interest rate for that. So they do have different products for different ranges. And I think that's completely reflective of all of the alternative finance categories, whether it's in asset finance or property financing. You'll have different lenders at different risk appetites, and the risk bandings are driven by things like the age of the business, the financials of that business, the growth of that business, and as such, they'll get a different credit banding. And depending on the banding, you'll have different alternative finance providers looking to compete either at price, either at speed, or else help on a cash flow side of things. So where you might see a business owner opting for a slightly different or a slightly more expensive rate is because they can get the facility over maybe a 36-month or a 60-month period versus a cheaper facility over a shorter period of time. So yes, definitely not saying that there isn't expensive facilities on the market, but normally the reason that they're offering that is they're willing to take a higher risk on that particular business. And then specifically in the point you raised, Iwaka, they absolutely do have some of those prices, but equally they do have lower price products as well. I'll just quickly finish out this because I'm conscious to pass over to Sam on the equity side of things, and then great to see all these questions coming in, and we'll look to answer them as we go. So just rounding this up in terms of just giving you an angle of some of maybe the short-term financing solutions, section of invoice, revolving credit facility. So this is kind of like your rainy day fund. We saw a lot of the banks pull back overdrafts because for every overdraft they held, it affected their lending capabilities because they had to hold on their balance sheet the full overdraft for any businesses that they had an overdraft with. So as such, there's a real dearth of these kind of overdraft type products in the market. So what we've seen is more and more revolving credit style facilities hit the market from alternative finance side of things, where they're analyzing your business and giving you a line of credit. And then different providers have different tactics in terms of how you can use that line of credit. It could be you get an invoice from the supplier, you can draw down funds against that, or you've raised invoice, you can draw down funds on that. But essentially what it gives you is real flexibility. So you only pay as you use it. And then as you pay back, the credit line replenishes, or even in some cases, it continues to grow. So we're seeing a lot of popularity with that as a product line. And then finally, just quickly to touch on one of the kind of more traditional ones, often called merchant cash advance, or kind of rebranded as revenue-based finances. We've seen like a swathe of growth in e-commerce businesses. So essentially, that's looking at your data that's coming through your credit card terminals, your Shopify data, and what that's doing is analyzing what's the average amount that you're getting, and what these revenue-based facilities or merchant cash advance facilities is they advance you either your average month amount or 1 times, 2 times, 3 times that average monthly amount, and then you repay that against future income that you're generating. So a percentage of your future sales pay down that facility. Typically, we see these facilities lasting between 3 to 12 months. And often there's a high renewal factor. So businesses that do start to use these, they tend to renew them. Ultimately, usually after 4 or 5 times of using that facility, they prefer to move on to something that's a bit better from their cash flow perspective. So you often see businesses that have taken a merchant cash advance refinance that into a traditional term loan that they can spread over a 60-month facility, which gives them more control over their kind of monthly cash flow, but it's also giving them more buying power by getting a larger facility upfront. And then, yeah, typically speaking, you would see revenue-based financing facilities kind of more on the expensive side of things, because you might be using for those 3 to 9 month periods. You're kind of seeing in a kind of like a 2% per month type rate there. And then finally, before passing over to Sam, again, in the alternative finance space, it's not just about short-term working capital. There's lots of players here, particularly in the asset finance, commercial mortgage, and invoice finance. And all of these players at a tier 1 level can absolutely compete on bank pricing, get into those single digits. But what they can also do is compete on speed. So again, if you're purchasing assets, maybe from a cash flow perspective, it makes sense to lease them, reduce those cash flow side of things. Or indeed, if you do want to purchase them and write them off your million allowance, again, to mitigate against corporation tax side of things, asset finance is a great strategy for that. With the interest rate reductions over the last kind of 12 months, we've definitely seen a lot more competition and drive within the commercial mortgage space, both from tier 1s and challengers. And on the invoice side of things, we've probably seen a lot of the tier 1 banks pull away from this. So more of the alternative finance providers are taking care. But yeah, I'm conscious of taking a lot of time in the debt. So I want to hand over to Sam to kind of introduce the equity side of things. And then I see we've got 11 questions. So once we do that, we'll then take a round of questioning before finishing off on the grant side.
Thanks, Kieran. And it's really interesting to see the change in the kind of those tier 1 banks. I remember we were bootstrapping our tech business. We got to 20 million revenue and we had a working capital crunch, as you do when you grow. You know, we were doubling year on year, and we needed £50,000 to get through a tight Christmas period. And our tier 1 bank, who we had, you know, one-on-one relationship with a bank manager, so we were pretty lucky there. We needed to give personal guarantees in order to get the £50,000. At which point the founders just went, we'll chuck 20 grand in each ourselves and be done. Yeah, it just seems, so it's lovely to see them relaxing a little bit there.
Yeah, for sure. And you can get PG insurance now up to £400,000 as well, which is
okay, yeah,
interesting product that's hit the market. But yeah, sorry.
It just felt more painful than it was worth.
Yeah. Crazy is they're looking for 50,000 PG when you're doing 20 million.
So that was a great introduction to the different sources of debt fund. And I thought equity was confusing. I think debt, there's a million different products, and it's great that Swoop can help you navigate those. What does equity funding mean? Let's introduce it first. Broadly, equity funding means you are selling shares in your business to an investor that is hoping that, you know, they spend £10,000 on your shares and you give them 100 times return and they get £1 million back. That would be absolutely perfect, or even just a 4 or 5 times return on their money. So unlike debt, where you are broadly borrowing something and paying it back plus an interest, and that's an over generalization, I know, but broadly that's what that is. Equity is where you are selling shares with no expectation usually that your investors will receive anything back until you hit an exit point. So until you float on AIM, or you know somebody acquires your business or whatever. Broadly in the UK, there are different types of equity investors, and this diagram brings to life most of them. Now, it's worth mentioning that nobody jumps from place to place on this journey and does every single one. Sometimes people will bootstrap for a bit and go straight to VC. Sometimes people will skip bootstrap. They'll take angel money and then stop when they take, SEIS funds or whatever. So, but, everybody's journey is different. But broadly, a few things change as you go around the journey. The first is the sophistication of your investor gets much better. So if you're bootstrapping, it's you giving your own money. So you're pretty sophisticated, I guess, but it doesn't really matter. Friends and family, the bank of mum and dad aren't going to be that fussy on the legal terms or whatever. They just want to support you all the way around to VC, whose job in life is to squeeze every single, right and protection and opportunity they can out of your business, because they have a legal duty, or what's called a fiduciary duty, to their investors. So the game that's played by VCs is very, very different to angels, for example. The other two things that happen as you go around this journey, typically the amount you can take in funding increases dramatically. So from the bank of mum and dad, you might get 50,000 if you're lucky. From a VC, if you look at, the WeWork investment via SoftBank, that was tens of billions of pounds. And therefore, typically the valuation at the value of the business at the point the investment made is typically much higher as well. There is a lovely, lovely sweet spot on this journey, and I'm going to introduce a phrase, SEIS, EIS, that I bang on about constantly. But there's two tax incentive schemes in the UK called SEIS, EIS, and I will talk through in mind-numbing detail on the next slide why they're absolutely amazing for your investors and why you are pretty much uninvestable without SEIS, EIS. But they fit in, if we can flip back one slide very quickly.
Sorry.
They fit in a real sweet spot in the UK ecosystem between friends and family. So sometimes your friends and family can make use of SEIS, all the way round to SEIS VC funds or SEIS funds. So anybody between those two parts, the investors will almost certainly be expecting to make use of SEIS, EIS. And you might be thinking, as a founder, why do I care about SEIS, EIS? The only benefit is to my investors. Well, there's two reasons why founders should care about SEIS, EIS. Firstly, if you're looking for funding from anywhere between friends and family and SEIS funds on this diagram, your investor's going to want to make use of SEIS, EIS. So it's table stakes. You've got to be prepared for it. You've got to be able to talk that language. Otherwise, your investor's just going to walk away. The second thing to realize, and this is a hidden benefit of SEIS, EIS, the legal terms that your investors can get when they invest in your business are much softer under SEIS, EIS investments. So when you take money from VCs, you'll have some really horrible founder unfriendly terms, things like liquidation preference, non-diluting shares, anti-dilution share rights. You may not know what those things are, but they're very, very, very investor friendly. When you take money under SEIS, EIS, as an angel investor, I get the choice of either those amazing tax breaks that we'll cover on the next slide, or those really punchy VC type terms. And investors always go for the amazing tax breaks. So whilst you're taking money from SEIS, EIS investors, you are getting really, really founder friendly terms compared with VCs where the gloves absolutely come off. So let me, if we flip to the next slide, I'll talk through exactly why investors love SEIS, EIS in the UK. First thing I should do is formally introduce the scheme. SEIS is the little brother and stands for Seed Enterprise Investment Scheme, and EIS is the big sister, if you like, and that is just Enterprise Investment Scheme. These are, and the title says it all, these are your superpower in the UK. At an early stage, if you're looking for funding, you absolutely need to be talking this language. Let me give you an example of why SEIS is absolutely magical for investors. Imagine I put £10,000 into your business under SEIS. The first thing the government does without missing a beat is give me back half of my investment. So I get £5,000 back as an income tax relief almost immediately, which is amazing to start with. The second benefit is something called capital gains tax exemption. So if I put £10,000 into your business and you convert that to £1 million, so 100 times return on my money out after 3 years, then I take out that £990,000 of profit without a single penny in capital gains tax. So it's absolutely, completely tax exempt from an investor point of view, which is, again, absolutely amazing. The third benefit is slightly less cheery, and that's something called loss relief. So if I put £10,000 into your business, I've already had half back. If the business fails for whatever reason, it just doesn't work out commercially or whatever, then the government will give me back roughly another 22% of my investment. So for every £10,000 I invest under SEIS, I'm just risking £2,750, which is really great. So I'm not risking the whole £10,000. The final benefit is even less cheery than loss relief, and that's inheritance tax exemption. So if I invest in your business and I get hit by a bus and die after 2 years, then my investment in your business passes to my estate outside of that inheritance tax calculation. And inheritance tax is currently running at 40% in the UK. Now that is subject to a 1 million lifetime limit. But that's a way in which SEIS and EIS can be used for kind of tax planning and wealth planning for slightly older investors, just like me. The downside of SEIS, so the tax breaks are absolutely phenomenal. SEIS is meant for very early stage businesses, so you can only raise a maximum of £250,000, and you can only raise that for the 3 years from the date you start to trade. So typically companies will, first funding round, pre-seed, pre-revenue, make use of SEIS, and then you move on to EIS, where you can raise much more for a much longer period, but the tax breaks are proportionally less. And the reason for that is SEIS is meant for, the most early stage companies in the UK, and therefore they're considered most risk, and therefore the investors need more incentivization. By the time a company gets to EIS, then the theory being they're less risk, and therefore the tax breaks can be less. Everybody always asks, if I want to raise £500,000 in my first funding round, what do? Do I just use EIS? And the answer is you use both. You do what is called a dual round. You raise 250 under SEIS and 250 under EIS. I'll give you the same worked example under EIS, and then we'll canter through the next slides because I realise we've still got a lot of content. Under EIS, you can raise much more. So you can raise a total of 12 million. You can raise a maximum of 5 million a year. And you can start raising from 7 years from the date you make your first sale. So all of the limits are much, much increased. But as mentioned, the tax breaks are a little bit less. Under EIS, if I put £10,000 into your business, I don't get 50% upfront, I get 30%. So only £3,000 out of the £10,000. So it's good, but it's not as great as SEIS. The loss relief is proportionally less as well. So I'm actually risking £3,850 of every 10,000 I'm investing, compared with 2,750 under SEIS. And the capital gains tax and inheritance tax exemption are identical across both the schemes. So hopefully you can see, for all of these reasons, SEIS and EIS are absolute game changer for startups in the UK. There is a final type of EIS, which is known as knowledge intensive company. I'm not going to dwell on this one, but for deep tech businesses that need to raise much more over a longer period, you can raise up to 20 million, 10 million a year over 10 years. So it takes the EIS limits and extends them even more. The next obvious question, once you've heard this, is, that's great, I want to do equity fundraising. What are the 5 things I need to prepare to do so? And cue the most garish slide within the deck, I'm afraid. Sorry, Kieran. These are the 5 things. So as an angel investor myself, these are the 5 ducks I want to see in a row. The first thing is a pitch deck. I'm not going to teach everybody to suck eggs here, but if you need support on what a pitch deck is, there's loads of support. We've got a free stuff page on our website which details lots and lots of details around. We've got a template pitch deck, for example. But anyway, a pitch deck is basically you explaining what's the problem, what's the solution, why you, why now, what's the market, what's the forecast, what's the team, what's the ask. So broadly, it should follow something like that. The second thing you need is a financial model. So that should cover at least 3 years. It should ideally cover enough years to make you look profitable. And it should be in a standard format: revenue, cost of sales, overheads, EBIT, and then a proxy to your cash flow. And again, on our free stuff page, we've got a minimum viable forecast model that's usually a great fit for pre-seed, pre-revenue businesses. The third thing that investors are likely to ask for is something called SEIS and EIS advance assurance. So SEIS, EIS are the tax schemes. Advance assurance is your only way of proving to investors that your business is eligible under the scheme. So that's one of the services that FounderCatalyst undertake. We've got a 99.8% success rate, and we do it for free when you commit to a funding round. But advance assurance, it sounds grand, doesn't it? But it's literally an email from HMRC stating that your business should be eligible under the scheme. So that's the third, I think. The fourth thing you'll need is a term sheet. And a term sheet is, when you do a funding round, you get over 100 pages of documents, which is all good, fun. But your investor doesn't want to read those 100 pages of documents to understand the offer you're making. So there's a little document called a term sheet that you are responsible for producing, and a term sheet squishes all of those 100 pages of legal mumbo jumbo into 4 or 5 pages. So it summarizes what deal is on offer, what company's being invested in, what's the investment mechanism, and what rights and protections are you offering your investors. So it's a really important document. The fifth and final item is a valuation justification. So 5 years ago in 2021, when the market was really frothy, you probably didn't need a valuation justification. The world has changed now. Equity funding is much tougher than it was 4 or 5 years ago, and investors are typically looking for value. So you will need to justify why your valuation is 1.5 million or 2 million or 3 million pounds or whatever it happens to be. And there are lots of great resources I can share in the chat around how to value your pre-seed, pre-revenue business. So as an angel investor, those are the 5 ducks that I would want to see from from founders, sorry. And to give you some idea, it usually takes up to a month to produce those 5 items. It's not hugely time consuming, but if you want to go to fundraise at the peak time in the UK, which is January to April, you kind of want to get your ducks in a row ready for January rather than getting to January and go, I haven't got any of this stuff prepared. Phew, that is a sheep dip into the world of equity.
That is brilliant. What I'm going to do, because it's fantastic just to see so many questions coming in here, is I'm going to do 5 minutes of trying to clear some of these questions down. Then I'll do a quick 5 minutes on grants and R&D, and then we'll come back with another 5 minutes for questioning if that works. So let me just look a couple of the last couple of questions that came in, because they're going to be equity orientated. So I'm just going to fire them across to you here. When does the clock start ticking on the time criterion? Set up a business, first sale.
So there's 2 different rules there. For SEIS, the clock starts ticking from the day you start to trade, which broadly means when you try and first sell something. Under EIS, the 7 years starts ticking when you first actually sell something. So annoyingly, there's a slight nuance between the 2.
It's also similar for businesses looking to do this government-backed startup loan. So if you're a business that's looking to get access to the startup loan scheme, which is any business who's got a director that wants to get access to up to 25,000 at a flat rate 6% and spread across 5 years, the same kind of similar thing with SEIS, where the clock starts when you make your first commercial sale. And so definitely a good product to be aware of if you're in the stage business. Okay, next question. Do you have a guide on how to find these pre-seed investors?
We do. We've got a guide which is actually a guide we make available on our for paying customers on our portal. I'm sure I've got something I can share. We'll share this. I'm sure we'll send an email afterwards, and we'll give you some pointers on where to find it. I mean, broadly, there are 100 and something angel groups within the UK. That would be my first place if I was fundraising. I think those 100 angel groups in the UK are a really lovely source of funds. So firstly, check the ones geographically close to you. And secondly, if you've got a very specific vertical you're in, there are also angel groups that just look at those verticals. So I think angel groups, trying to chase individual investors is very, very painful, and you need to kiss a lot of frogs. So I think those angel groups are a perfect blend for me.
Yeah, absolutely. Obviously, quick plug on Swoop. If you want to go and access some investors there, by all means, set up an account and have a look. Few little housekeeping ones. Any of the links, resources you mentioned around soundbite valuations, we will do an email out to everyone on the webinar with links to not just the actual webinar content, but any of this follow-up stuff. So I'm assuming, Sam, we can put any links on the FounderCatalyst side of things to any of the valuation stuff you mentioned.
Yeah.
Super. We can do that. And can you please share the slides after the webinar? Yeah, you'll all be getting an email with all the slides on it, so don't worry. Okay, here's a more meaty one for you, Sam, and then I'll flick into some of the grants and then come back to the questions. So they're coming in, which is really, really great. Lovely to see. Uh, what are the qualifications for SEIS, EIS? My father sold a factory for 1.2 million and was told explicitly by our accountant that we would qualify for the scheme. We then learned sometime after the money had already been invested into my business that we didn't qualify and were giving capital gains tax bills of 250K. Not sure if all of the information is there, Sam, for that, but
Yeah, I mean, yeah, I can't, not entirely
yeah,
sure what's happened there. I mean, broadly, there are, the SEIS, EIS legislation are about 100 pages, so there are lots of rules, and there are rules around the company, the shares, the trade, the investors, yeah, and everything else in between. So it's very, very complex. I mean, selling a factory for 1.2 million, I don't really understand the context of that. So, Jonathan, happy to jump on a call and have a natter through your exact circumstances. But that feels unusual.
super. Okay, I'll quickly just go through a quick blast on grants, and then we'll come back to and hopefully clear all the remaining questions. So I just wanted to really touch on grants for a second. They're obviously very attractive because unlike on the equity side of things, you're not paying back capital interest, and again on the equity side of things, you're not diluting the business. So what's not to love about that? Now, there's plenty to probably not love about it, because a lot of people have their gripes when it comes to grants, namely where do you find them, how do I access them? It seems really, really hard, and the application system seems like some sort of marathon to go through, all of which have elements of truth to it. But as I said at the top of the call, as someone who's managed to get, I think it's about 8 million of grant funding into our business, that's definitely been a huge accelerant in terms of what we've been able to do as a business and invest in our technology and grow our business out. So I definitely think having hyper awareness around the grant ecosystem and what's available to you is super, super important as a business owner. When understanding kind of grant funding, it's often good to understand it from a technology readiness level. So you've got these TRLs from a 1 to 9 schema that often get applied from your research stage, your development stage, where you're kind of demonstrating, kind of showing product market fit and getting fully operational. Often, most of the grants tends to focus in that 4 to 8 range, where you have proof points in terms of your research and understanding of what you'd like to go and do, but ultimately you want to get the grant to develop this innovation, new technology, new way of processing, and then through that demonstrably show it's starting to impact, so it's getting into that commercial phase. So a lot of those grants are going to be set out in that kind of 4 to 8. So it's often good to think about it when you think about why you'd like a grant. Does it fit into that kind of phasing of, I'm getting into a development stage, I'm going to do something really tough and innovative and daring, and I have a way to go and test that out. That's often where a lot of these grants will sit. Sorry, and just before going on to the R&D side of things, where can I go to get grants? Well, at a regional level, your local enterprise hubs, there are 38 of them around the country, they'll often have different grants. So different hubs will have different types of grants set out, whether that's on a training side of things, a lot around capital allowances. Like if you're buying heavy machinery, particularly if you're in things like agriculture, it's always really good to check with your local enterprise or check with your growth hub to see if there's any match funding that can go alongside that. At a national level, Innovate UK is a really, really great source. And again, they're always kind of going at a certain thematic. At the moment, agriculture and automotive is very much the hot topic. So if you're in either of those sectors, there's a lot of cash coming out. The next Innovate UK segment that they're going to be targeting is healthcare. So we're expecting a big wave of healthcare-based grants. I know we're talking about like grants here, but Innovate UK also have a loan scheme that we've seen a lot of capital go out. The latest call for that Innovate UK loan scheme went out yesterday, open until January 9th. Reason that's interesting is you can get interest-only loans for the first year at 3.7% before that rate doubles up. So again, very attractive in terms of getting cash in to prove and build out your innovation at a very affordable rate. They can go up to 5 million. And again, since the UK has paid back into Horizon 2020, European grant funding is now available again for UK businesses under the EIS scheme. So that's very, very important to be aware of. And again, opens up a wider pool of optionality. So it's super important to be aware and cognizant of what grants exist in the ecosystem, because they can add tremendous value in terms of funding routes in. But cognizant of time, I'm just going to quickly run through, but if you do have specific grants questions, hit them up in the box, or hit me up later on. R&D scheme, really, really important. If you are investing in new technology, new software, anything from a science and research perspective, go and run the calculation, sense check, are you eligible? Because again, it's a fantastic way to either get cash back in if you're a loss-making business, or reduce your corporation tax bill if you're a profitable business. And the scheme has had a lot of heat, probably fairly, where people have not fairly gone through the scheme. So HMRC have come down on that rightly, but underpinning the whole scheme is the right ethos that if you're going by it and you're following the calculation, then justifiably you can get those investment costs back in, whether it's the engineers, the hosting, any of the technical tools that you're utilizing within the UK. And so absolutely just calling this out as a fantastic scheme for businesses that are spending in these categories to be super aware of. Okay. We've got 8 minutes left, and we've got quite a good few questions to get through. So if you can just keep putting the questions in, we'll try and get through as many of these as we can. I am a pre-revenue startup. I applied to an organization that sources investors. They came back with a loan offer from one of their members. In order to arrange the offer, they are asking for a fee of $1,950 to be paid up front before I even engage with the loan provider or ask questions. Is this standard practice, or could this be a scam? What do you advise? Obviously hard to know without seeing the full picture, but what I would say is that it does seem unusual, and particularly where you're a pre-revenue business and you're not being allowed to find out any information about who that provider is, how it would work. And so it would seem highly unusual that you would be forced to pay a sum of money up front before engaging with that funder in any way. Would be my 2 pence on that. I don't know, Sam, if you have anything to add on that front.
Yeah, I'm careful. You know, lots of founders get lots of approaches for give us £10,000 and we'll help you, whatever. I'm very wary of upfront fees without any without any kind of guarantee of success, or so. Yeah, it's buyer beware, I think, for sure.
Yeah. Paul, I know you asked the question before on the IWACA side of things, and you've asked, presumably the larger value of a debt transaction, the longer it takes to be approved. And yes, that's definitely true. As I mentioned, where we see those kind of segments of speed, 50K and below, we would expect kind of a 24 to 48 hour turnaround if you've got all the data in place. Similarly enough for 100,000, potentially a bit more on management accounts, where you might just need bank statements at that 50K level. Once you get into that 250K and above, as well as having the management accounts and the bank statements, you're kind of getting a bit more of the qualitative information, similar to an equity stage, where you'd expect to see at least a forecast model to underpin the presumptions of, if you take this capital on, what's that going to look like. So that's where you kind of have a longer phase of analysis. So you might be 2-3 weeks, and then if it's $1 million and above, that's where you get a much broader piece, and again a bit more swim rich, like equity as well, where you're looking at the market, the team, everything under it, as well as kind of those core financials. And so yeah, the larger the facility, the longer usually those kind of credit processes are to run through. Next up, Esther, other than grant applications or innovative schemes, I see R&D tax refunds or credits, but no help for a company not yet trading. Do you know of any other source of funds, other than equity, I mean, for companies in R&D stages and pre-revenue? So I briefly touched on it, but the UK startup loan scheme is very much designed in this specifically. So any director in a business within their first 36 months can get access to up to £25,000. So if you've got 2 directors, it could be 50, 3 directors, 75, or you don't necessarily need to take all 25. You can take £500, 2,500. Might take that for a year, and then you can go back and take some more. It's done at a very favorable interest rate at 6%, which again can be spread over 5 years to help manage those monthly payments. So that scheme is definitely something extra that I would say is worth taking a look at from a pre-revenue point of view. I don't know, Sam, have you seen anything else on the pre-revenue side of things that
No, I mean grants and equity broadly are the two go-tos, I think, in that space.
super. Following up on the copycat question, how willing are investors to invest smaller sums in a product service that meets an urgent market need, has all the IP in place but hasn't yet gone to market? In other words, higher risk, higher reward, and will be a better approach to talk under an NDA to a company which is in the same sector but doesn't offer what you have, for which your service would be a good fit.
If I take the question on, how happy are investors investing before you go to market? I mean, the answer is, this comes back to the valuation thing we mentioned earlier. If you're pre-seed, pre-revenue, then you should be raising less and your valuation should be less because you are maximum risk. But on the flip side, you're offering SEIS, which offers those kind of amazing tax breaks we've discussed. So there are lots of investors still that invest, angel investors in the UK that invest pre-seed, pre-revenue. So I think that's straightforward. It's less, there are less of them around than there were 4 or 5 years ago, but they do certainly still exist. I mean, you could go, I think there was a second part there around going to, competitors or people already in the market and trying to sell their product. I have my doubts whether that would work or not. They're not going to invest in you probably. And, no matter how good the NDA, they may take some of your ideas and go to market with them, knowing that, it costs 50 grand for you to take them to court and sue them for stealing their idea under NDA. So you're probably not going to be able to afford to do that. So I'd be very wary of the partnership idea at an early stage, certainly before you go to market. I don't know, Kieran, if you've got any other take.
No, I would completely agree with you on that, Sam. Okay, just quickly digging in, I see John has a question regarding the selective invoice finance. Is there an upper or lower limit for the amount you can borrow against those invoices? Not really. I think the good news on the selective invoice side of things is, as I said, we can go as low as I've seen it go as low as £100. And again, you can get up into the hundreds, thousands, million on that. So it's a real flexible product. So real good flexibility on that side of thing. Jumping into one of Marcus's questions, there are some people who start a business without any means of funds. You've not traded. How can you give an invoice or a guarantee if you don't have any of these requirements? Where should you turn for help? You start a business without any means of funds. You don't trade. How can you give an invoice or a guarantee?
I think this is, if you can't, there's lots of companies who haven't raised an invoice, so invoice factoring doesn't work. They can't give a personal guarantee because that is unpalatable for lots of people. So then I think you go back to the earlier stage of funding. There's some debt solutions that Kieran's brought to life. That's where you speak to early stage angel investors, friends and family. And grants. Those are predominantly. There's no magic wand outside of the stuff I think we've already discussed today.
Yeah, I think that's also important. Like, as much as we want to show as many options as possible, sometimes there will be scenarios where there isn't an option available outside of just, I suppose, getting on and trying to build the business out. Which is important to flag. Imogen has a question around SEIS. SEIS, we were told we were not entitled because we need to buy a specialized property to operate from, and SEIS is not available for property. Is this true, or have I been misunderstood?
It's probably true. So if you have HMRC don't want you, raising £500,000 and spending £500,000 on a property, that they would deem that does not put the capital at risk because you've still own the assets. You would buy the property, and ultimately, if the business failed, the investors, they're still safe in knowing they've got 500 grand's worth of property. So that is why in these kind of deals, you would structure it in a slightly different way. You would have a debt solution, and Kieran can bring this to life much better than I can, but you would probably have a mortgage or buy it, via a pension fund or whatever, the property. So you would finance that in a very different way. And then you'd raise, say, £250,000 to kit the property out and to actually start the business. So broadly, I think the advice you've been given is correct, but there are ways to structure it that can work around. And let's connect on LinkedIn. I'm happy to talk through that specific circumstance.
Super. I'll just do two more questions because I'm conscious we're kind of gone over time. One quick one I saw is I believe historical loans are personal loans rather than business loans. So they are business loans, but the key caveat is how they credit assess you. Is obviously they're looking and seeing how the business will grow over time, but ultimately it's your personal credit score that's the principal driver of whether they will or will not give you that funding. But it is a startup business loan, but personal credit is absolutely key to the analysis of whether you're going to get it or not. And it's important to call that out. I'm just going to get a few more in here. Okay. How do I raise funds for a biotech requiring high investment in scientific equipment? Nice easy one there for yourself.
Yeah, there are lots of biotechs that make use of SEIS, EIS, and it's for deep tech like biotechs that EIS knowledge intensive company exists. You will find, a general angel like me, I will usually run a mile from biotech or deep tech because I am not bright enough to understand it. That said, I've got, if I look back, I've got an investment in a company called Skin Analytics that do melanoma detection using a smartphone and AI. I invested 7 years ago now, and they are still at early stage traction. There are several SEIS and EIS angel groups that focus on deep tech and biotech specifically. So you get people like Cambridge Angels, Oxford Innovation that have the skills to do due diligence and kick the tires on those kind of opportunities. And you also get specialist funds that no matter what deep tech sector, they'll put £1 million into businesses as an EIS fund. So there are sources of funding out there, but it's not as easy to get funding as, the latest AI SaaS play, for example.
Yeah, the only thing I'd chip in on that one with like scientific assets you're looking to purchase is a bit like buying cars, machinery, and they're deemed kind of like value assets that have easy or demonstrable to point to resale value. So when you're looking, even if you're the very, very early stages or just starting out, it is also always always worth looking at asset finance or leasing as a way to get those products that you want to do within that biotech space, so that you're not having to pay your own cash straight up front, and so you're starting to pay them on a monthly basis. So it's a good way to manage cash. So definitely something that I would have a look at. Just on just I'll do these questions aren't stopping. So maybe I'll do one or two more, and then I'm conscious we'll go over. But what we'll try and do is get everyone's questions and then put some answers into it. So just share them back in the notes as well. So apologies if we haven't got to your questions, but I'll do two questions left, two more questions, one debt, one equity, and then we'll have to call it a day there. But really appreciate everyone being so interactive and firing all these questions in. One for you, Sam. If I want to raise money from an SEIS or SEI and an SEIS investor for my UK HQ, but the money is destined for expansion into a subsidiary for a third country, I'm assuming not the UK, would this be SEI and SEIS eligible?
Broadly, you can make use of SEIS and EIS for exactly that purpose. The money doesn't need to be spent in the UK. It can be spent via a subsidiary. The devil's in the detail as always. But Mark, let's have a chat. I think that one does work.
And then, okay, final one for me on thing, because I think it's a nice one to give you, John Freeman, who says, is it possible to fund a ledger with over 90 days debtors, but no bad debt history? Absolutely. That is definitely something that can be done. So if you want to have a look at that, please reach out to Swoop. We definitely take a look at that for you. Okay, we're just not going to be able to keep up with the velocity of the questions here at the time, but thank you so much everyone for joining. It's so great to have so many of you join and be so thorough in your questioning. We'll be sharing all the slides, all the links. We'll also distill all the questions that have been asked, put answers next to them, and I'm sure this won't be the last Swoop FounderCatalyst funding source webinar we do. But yeah, really appreciate everyone's time, everyone's questions. Thanks again, and thanks a million, Sam. Amazing knowledge and input from yourself.
Yeah, it's lovely to be here with Swoop and Kieran. It's been a blast. Thanks for your time.
Super. Thanks everybody. Appreciate it all. Have a lovely Tuesday.
Take care.